I was convinced about the macroeconomic, functioning, of the markets, which has continued to this day. I mean, it's something that is really important to look at from a forward-looking, expectation.
Hello, everyone. My name is Shana Orzik-Sissel, and I am the founder and CEO of Bonrian Capital Management. And this is What's the Alternative? Today we have, I think we say this every time in the intro, and it's never not true, but I guess it's cliche. We have a very special guest. Today we have Brad Zapp with us, and Brad's special for a lot of reasons. Number one, Brad and Connetic Ventures are not only a partner on the platform, but an investor in Bonrian itself. So if you love Bonrian and you love what we're doing, and you want to kind of invest in us, so you can invest in Connetic's fund and subsequently get some exposure to us. With that said, the thing that makes Connetic so different is that Brad's journey and Brad's story is really unique. And I think the advisors in our audience will really appreciate it. So without further ado, welcome, Brad.
Thanks, Shana. Really appreciate being here.
No problem. I'm really glad that we finally got you on. You've been with us for a long time, but we know you've been working on some things behind the scenes. And we'll get to talking about that as we kind of go on. But why don't you tell our audience a little bit about your background and sort of how you got into the finance industry, and then your path and my path are similar. And I'd love for you to share with our audience kind of how you progressed, because it's an unusual path, to say the least.
Yeah, so I'll start with where I'm at today and then kind of backtrack, because I don't think this is the traditional way that you would end up here. But today I'm the, co-founder and president of a venture capital firm. I didn't start out in the private markets. I didn't start out in investment banking, private equity, venture. I've never been on the coast or anything like that. I actually started out as a financial advisor, a very traditional, RIA, and I ended up finding my way here. And which is, if you want to put a little extra wrinkle into that, I'm also from the greater Cincinnati area, which is a great area, but nothing typically unique or forward thinking, starts out of that area. So it would be weird for an advisor, and I had good success, to sort of leave that industry and, go to the portfolio, management side. But the thing of it is, I was an advisor. It's in a very, very different time. And so when I started in the industry, first as a broker, in 2000 to 2003, and then as a RIA from 2004 to 2013. If you go to the history books and you look at the markets, the capital markets during that time, it was terrible. I mean, it was terrible. Like everything that I learned in college or from my mentors, nothing worked. First I go through, the dot-com bust. My first three, literally the market went down from the day I stepped foot, on a trading floor. And then as soon as I got my breath back in late 03, by 07, with the real estate pullback and the Great Recession, things, started to pull again. So it wasn't a fun time to be a financial advisor. I would call it an exhausting time. The benefit to that, for me I was very young then, is I had to cut my teeth in live fire on, low correlation and really, diversifying strategies. And the topic du jour these days is you'll hear either private market secondaries or alternatives would be like the three slangs. And everyone's all into this, but that was vital to my success. It was vital, forget success. It was vital to my survival. I wasn't going to have a business, during those time periods. But the thing of it is, they're not easy for an advisor to allocate across my entire book of business. And so when you're, financial advisors have to consider their clients' needs, but they also have to consider as a business owner, the business needs of my practice. And it's not like I could just go out and press a button like, oh, here's the easy button, like Staples, and just allocate, to private equity or something like that for my entire client base. So to put it in perspective, I I feel like I was a very typical advisor. I think a lot of advisors out there will resonate with the size of practice I had. We were like, three, maybe 400 million. We had about 450 households. I had about 1,800 accounts. So a nice chunky size, for the time period. And so you needed things that were scalable. We we specialized, in the small business owner clientele. Some were accredited, some were not accredited. All were affluent, and so again, it was very difficult. It wasn't as simple as me deciding, oh, I think some of these commodity strategies are really good, or I think this, tech and venture capital is pretty good. We would be aware of plenty of these strategies, but there wasn't a product that I could put in everyone's client. And so at the end of my tenure as an advisor, the exhaustion, basically was 5 to 10% of my practice thought I was brilliant because I did allocate them appropriately to lots of diversifying strategies. And they did notice a difference in their portfolio. And I got more credit than I deserved. But 80 to 90% of my book of business, they didn't think I was any different than any other advisor out there because their money just flowed, with the ebbs and flows of the capital markets. But there was nothing I could do. And so I was just sort of hell bent. I was just, at the end of that, I was like, it shouldn't be this way, whether that's from a regulatory standpoint, business model standpoint. There has to be some tools that we could put inside of our models. And so I really wanted to build, some sort of product. And that would be hard to do from, at the time, from a compliance standpoint inside my firm. So I told my partners, I said, I love you, but I'm tired and I want to go build something. How you feel about buying me out? Let me do it. And they're wonderful partners. The firm's even bigger. Maybe I was dead weight. The firm's even bigger now than it was then. So they bought me out. And then I started my journey towards building what we have today.
So it's so funny listening to you tell your story because it's not all that dissimilar from my own. So I started in the business as a broker at Morgan Stanley, 2001-ish, early 01, late 2000. Same thing. I used to joke that I don't, all these advisors have been like through the 90s and the late 80s. What does the bull market look like, please? Like, I have no idea. Because I never experienced one until we got out of the financial crisis. And now we got a whole generation that knows nothing but. And it's weird to me to think that, like, if you think about that, 2011 was 14 years ago. So, the average late 30s advisor, that's all they know. And for you and I, our entire beginning of our career was different. And so we think different. And same exact thing is I ended up leaving that job because, as you put it, you were tired. In my case, I was like, that's God's work. And I just don't have the personality to be able to be people's therapists. And because it's exhausting, you're constantly having to like reassure your clients that you're doing the right thing and to work really hard to keep them on a path. And as you know, unless you're an RIA, you don't have discretion and you can't necessarily keep them from doing the wrong thing. And even if you can, they'll leave you in a heartbeat if you push too hard. So it's a fine line. And so just like you, same thing. And I got exposed to alts by taking a job doing institutional allocations. The space had the exact same vibe and feeling of it, and then really got into like the 40 Act stuff. And I think that's a good segue into, kind of where Connetic came to be, how it kind of came to fruition, how it's different. And actually, the reason you and I it felt like we really understood each other from the first conversation. And I think you were so interested in what Bonrune was doing is because you and I were looking to solve basically the same problem. So tell us a little bit about Connetic, because every time I talk to advisors in Cincinnati, they all know who you are and they're all investors. So we want advisors outside of the greater Cincinnati area to know all about Connetic. And I think that it would be great to hear kind of how Connetic came to be and how what you're doing is in a way colored by your early experience as an advisor.
I mean, it's for sure. So when I knew I wanted to build something, some sort of solution, I really had I didn't have my clients in mind so much as I had the advisors in mind. I mean, that sort of anxiety, that I went through, I know was felt by tons of advisors that washed out, during that time period. And I thought, we could do something and build something, that would help them, in their businesses and ultimately, help their clients. It's not like I knew that I was going to do venture capital at that time. In fact, I was looking at a lot more like real asset, type stuff. And the reason is, again, being from Greater Cincinnati, the one asset class we really didn't have anyone near us that, could teach me was venture capital. I mean, that was a very coastal thing. I had heard about it. I knew it was uniquely different from private equity, but I wasn't even, I really probably didn't even consider that as an asset class. It wasn't something that was real, right? There wasn't even a private, not of substance. There wasn't a private fund that was around like trying to get our money personally or put our clients' money in it. But probably around 2011 or 2011, the world sort of changed. I think, Y Combinator out in the Valley really sort of set that wave of accelerators that just blew across the nation. And, all of a sudden you had 500 accelerators, every town had an accelerator, right? If you were a tech hub, you had an accelerator. But it did a great job of, so we had like 3 pop up within a 2-year span in Northern Kentucky and Greater Cincinnati. And I got to say, it did a great job of creating that vibe, that energy. And I didn't know what it was. I really struggled. Is this philanthropy? Is this investing, coming from very serious, RA world? And I sort of like dove all in to solve this riddle in my head. And it was kind of like, does anyone make money at this? And if they do, why is this not a part of every advisor's portfolio? And it was really just community driven in my mind. And I kind of, became involved and personally invested in all these different things. And that's when I decided, man, I think this like could be like the next decade, really important, way to invest, because there's a fundamental change that was happening in the markets that I think a lot of advisors don't know about today. And I think it's really important when you think about asset allocation to understand this. And this was all happening during this time is, our economy was roaring, right? It was doing really well. It was growing, from the time I left to today, might be up 50% or something like that. But at the same time, about 50% of the public companies went away. That's weird, right? Like that's weird during a good time. And what was happening was the success of the venture capital industry with all the fundraisings and financings happening in the private markets was really front running, the need, to do this IPO. So like commingle all that together, I was like, this is what I want to do. I think this is the next 30, 40, 50 years. This is the future. I think this is a wave. These private markets are much larger than, by count of security, much larger than the public markets. And so I set out to build a security or a product that I could take back and I could sell to all my friends. And I didn't know what I was doing. Like I said, in my sales pitch for our first fund, which was like an angel fund, because I didn't know any different. It was terrible. I literally went out to 50 of my best friends and I said, I have no idea what I'm doing, but I really think this is a good idea. I'll work at it full time and we'll figure it out. And so that's kind of what we did. And it was very regional at the time. It was very the tri-state, localized stuff, because you would hear these angel groups talk about how wonderful their deal flow and their stuff is. Well, that went about as well as you can imagine. Not good at all. Turns out there's not enough deals in a hyper local way to build an institutional portfolio. So we just kind of kept at it. Again, I was convinced about the macroeconomic, functioning, of the markets, which has continued to this day. I mean, it's something that is really important to look at from a forward-looking, expectations of public markets versus private markets. So we were convinced. And so we just kept at it. And the thing of it was, we had 2 choices when we looked at the data. Choice number 1, if I really wanted to do something in a localized way, I needed to move to the coast, right?
Mhm.
I needed to either some way raise $1 billion myself, or I needed to hitch my wagon to an existing successful VC if that's what I wanted to do, because they do have enough deal flow on two particular regions in the U.S. But see, I had kids. I was anchored, right? I had kids in school. This wasn't going to happen. I couldn't move. So the second option was, well, if I can't compete sort of in that retail model of the Valley or Boston, New York, where are all the rest of the deals? And the good news is I found them. The bad news is I needed rest of country. And I'm talking everything. You couldn't just do, Cincinnati, Indianapolis, and Louisville. I mean,
Mhm.
you needed Canada, Mexico, and the entirety of North America. And I don't know how broad of a landmass that is, 10 million square miles or something ridiculous. But so I found the opportunities if you really wanted to build an institutional portfolio, but I couldn't get to them, right? They couldn't get to me. I couldn't find them.
Mhm.
And we made an insane decision, probably about 2018, was we became the nation's first digital VC. And this is pre-COVID, pre-Zoom, pre-Microsoft Teams, all this stuff. We just said, you know what? The only way that we can cover that level and eventually sort of drive deals is we needed to like set up a bot program, put it in the cloud, and have it talk to founders. And again, that went about as well as you'd think. Not good because nobody, everybody was taught. You've heard this, and I don't mean to like make fun of anyone, but the idea was founders were taught to get a warm introduction, right, to me. And it was probably frustrating for a couple, founders that were well coached and well connected that they could. I just told them to go talk to my bot named Wendell, in the cloud. And the benefit was everyone had to talk to Wendell, but everyone got to talk to Wendell. But it wasn't a thing. I mean, people weren't ready for a digital solution. I knew something. I knew we were going to have a digital revolution at some point in America. I just didn't know what it was. And of course, we all know what it was now. It was
Yeah.
COVID. And 2020, for all the political drama and all the health drama and all that stuff, that aside, from a business standpoint, it changed my life. And to put it in like numeric perspectives, we might have been lucky to get 14 or 15 opportunities a month, which is, again, you can't build a portfolio. In April of COVID, we had like 142
Wow.
because we were open for business
Right.
and the retail model was closed for business.
Mhm.
And, fast forward to this day, I mean, look at you and I, we're doing a podcast virtually. I mean, 50 to 70% of my meetings, are virtually, sometimes even when they're in the same town. And so
Right.
digital revolution was on. And we had built this chassis that could, capitalize, on that. And I knew that would cut my cost drastically from creating deal flow. And from that moment on, we started marching towards a product that was more suitable for distribution through advisors, which is where we are today. With something that works.
It's kind of crazy if you think about it. As you were telling that story and saying like COVID and the digital revolution and us doing this via Zoom, I can't help but think that that wasn't that long ago. But you're right. There was a complete and total, very fast cultural shift that all of a sudden, if you recall before then, the work from home thing was like, oh my God. If you worked from home, you were judged.
Yeah.
They were like, you're not really working. And it was like the biggest judgment in the world. And kind of like you, I had an opportunity early on before it was a thing to kind of see what that looked like if it was going to happen on a mass scale. I lived in Boston during the winter of 2015, which is when they got like 10 and a half feet of snow in 6 weeks. And it actually broke the public transit system. And so for like a month, the metro, the commuter rail lines didn't work, and neither did some of the subway systems. And the city of Boston basically said to all the companies in the city, we don't have enough parking spots to be able to support everybody having to commute in by vehicle. Our roadways the traffic's bad enough with the commuter rail and with the subways working. nobody would be able to get in the city. It would take hours. So they said everybody needs to work from home. So for a month, I had to work from home until everything got back up and running. And then after that, it was like spotty because they weren't running normal schedules. So like at Fidelity, we had a group that would come in a little early, but then they would leave at like 2 because they only had trains that ran at like certain increments. And so it was like COVID, but before COVID. And so I had an inkling of like, wow, this is actually cool. I like working from home. I can be more productive and I can do other stuff. And to your point, one of the things you were on the cutting edge of, and you didn't say it, but Wendell's kind of AI before AI was cool.
I call it Tin Man AI. I mean,
Yeah.
it's so funny because now you could have a banana that's artificially intelligent, right? If you don't put .ai after something, no one seems to care about it. But when we did it, and if I use those words, I would get, and we actually were using and are using AI. Back then it was machine learning, which is why I call it Tin Man AI, because machine learning's from the 70s. And
Yep.
they were like, total fraud, no way, AI is not a thing. Just
Right.
like digital wasn't a thing and then it was. And then AI wasn't a thing and now it is. And of course, our AI enhancements, because of the different LLM models, are radically better than they were when we first concocted this thing. But what luck did I get, because we had a digital tech chassis that was collecting all this data for all this years. And then you get AI in the last 3 years where you can sort of like, wow, I have this proprietary data, let's see what it does. And you actually had something to feed it. So we can do, and we are doing a lot more interesting things today, and we have a good roadmap for the future. But all this was blind luck. It was basically every door was shut in my face, right? It's like the hyper local model wouldn't work. No, I'm not going to move. We're going to go to the cloud. Nobody cared about the cloud. COVID hits. Everyone cares about digital. And boom, here we are.
Yeah. I swear, it's like we were on parallel paths because all of it kind of was happening around the same time for both of us. It's so when I want our audience to kind of understand how Wendell works, because when we were introduced, this is in 2023, I was introduced because you had Wendell and you were thinking about building out around Wendell. And as you talked to, and your team talked to us, we're like, well, why don't you put your deck in Wendell? And, we aren't the traditional kind of polished founders. In fact, purposefully so. But that means that like we make traditional venture capital very uncomfortable. Being female led, the way that we present ourselves to the world, and the way that we're basically taking on some really big players in the industry and saying, no, they're doing it wrong and we can win. I think a lot of traditional VCs like this woman is crazy. I don't think she's that smart, because they just look at me and immediately think that I can possibly have a brain. And so they kind of write us off. But when we put all of our stuff in Wendell was like, no, this is a good investment. It was validating for me because I was like, I know I'm on the right path. So as a founder, it was actually like something that made me feel like, okay, we're onto something, even with the judgment, even if people don't get it. And now I like to tell people that Connetic, and I think this is true, and correct me if I'm wrong, you really were the first AI-driven venture capital fund in the industry.
I believe that to be true. I think there's probably one or two articles I've read over the years of people that, I know there's a big tech company, very famous out in the Valley, that was doing some things. I think they had some struggles with their models. I have a theory on why. So we sort of took a weird tactic. So if you think of, traditional venture firms that are doing stuff, the growth stage ventures, like all the rage, right? Everyone talks about that, Series A. And I think one of the reasons, and it makes sense, is by the time you get to, you've been, 2, 3, 4, 5, 6 years old, you've got some, easily identifiable KPIs, financials. That's hard data, right? That's structured data that people can wrap their heads around. And there's certain metrics that, those VCs could plug in and they say, wow, that looks like that they've really figured it out. I'll just pour some growth capital. But the thing of it is, I was more fascinated with, again, this was just because where could I compete? I couldn't compete with those firms at that level. I really needed to front run those trades, and I needed to get, shares in these solid companies, before they reach that growth stage, which is going to be popular with founders anyways, because as you know, that's the hardest pre-seed and seed is the hardest fundraise you'll ever go through.
Mm-hmm.
But you don't have any of those metrics, and no company has those metrics at those stages. And so what possibly could I measure? And to me, it was super obvious, regardless of how challenging, because everyone says it out of their mouth. You know what?
Mm-hmm.
The founder, co-founder, and the early team is the most important thing. Team, 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 team. I'd bet on the A team and a B, whatever. We could go down all the, isms. And at one way or the other, whether it's the most important, the second most important, or third most important, it's almost unanimous that when you're an early stage product company, team is crazy important. But I was wondering, at all these different angel groups and all these different things that I had personally invested in, why was no one measuring this? If it was so important, you're telling me that it's impossible for me to assess whether Shayna or Brad or anyone listening has got high potential. Now, I don't think that's impossible, because they do it in other industries. They do it in athletics. I mean, they do it in the NFL. They do it in the NBA. You do it at NASA, the FBI. People matter. So we sort of went out in the world, and I guess psychologists just aren't investors. They don't make enough money, and that's why they're never part of the conversation. So we just started, calling psychology departments at different universities. I talked to tons of them. We read tons of books. We took many different assessments. And the weakness of all the ones that were available in the world was sort of their validation process, because they were based off like general population, or they were based off college educated general population. But I'll tell you something about founders and entrepreneurs. We ain't normal. And I really needed a data set. If I was going to do some sort of psychological experiment, I really needed it to be a comparative analysis of this very super special set of humans. Doesn't exist. So we just sort of took the knowledge that we had on how to build, what's really, most people don't know about psychology. It's a mathematical science. And so we built proprietary assessments from the ground up. And so Wendell's superpower is he's an AI psychologist. And Wendell delivers these proprietary assessments and tries to tease out, a couple of concepts. A lot of times we call them soft skills, but we take the soft skills, we turn them into hard data. And it's supposed to cut through the crap. Like no matter what appearance you put on, you're over the top. I'm a little weird. And that creates biases, which is what you're talking about. But let's cut through that crap. Let's get right to the heart, or right to the soul of who are you as a human? Who's your early team members? Can you even do this? Will you enjoy doing this? Because these things are important. The human, we're capable of anything. But if you don't like it, you're going to burn out. Burnout is probably the largest problem in Midwest founders, right? It's harder than they thought. Fundraising sucks. They don't want to pivot. It's just, so we cut through that. We take all these theoretical soft skills, we turn it into hard number crunching data. And when I look at founders through our system, I just see ones and zeros. I don't see you. I had no idea, sort of like your persona or anything like that. You just were compared to all the other founders in our system that were already either successful or not successful. And we're just trying to get an edge. And so we believe that highly gifted people that are suited for venture-backed startups have an edge over the average person. And if I build a portfolio of special people, we're going to make money. And we build an entire business off it.
I love that. I tell people all the time that I don't understand why they wouldn't want to invest in me. Like if you look at like my track record in life, like I'm the kind of person that like doesn't give up. And I was watching a video on Instagram recently, and it was Sam Altman talking about how the key to being a really good founder is being determined and also slightly crazy enough to think that like there's no way this isn't going to work, and somebody who just like cannot be told no. Because the vast majority of people, to your point, will reach a point where like they just burn out and they won't push through that with any sense of determination through to the other side when that moment hits them, when it just gets too hard. In many ways, having your team has been really helpful because there have been at least 3 times in the last 18 months that I've sat on the phone with your team and been like, it's so hard, guys. Help. I need help. And you guys were doing your thing, which we'll get to next. And you were like, we can't help you right now. Like, you just got to push through. If you can get to the other side, we'll be there with you. We will. I swear, just make it. And I was like, all right. And I did. And we continue to push through. It's like, I'll figure it out. Like, I'll figure it out. I don't know what, but I'll figure it out because I know it's a good idea. I know what we're doing makes a difference. And the ability to kind of see that through Wendell, because when we first did this, half the stuff that's happened hadn't happened. You wrote us a check in September of 2023, which is exactly when all of my problems started. In terms of my health stuff that like bombed out the end of 2023 and early 2024 for us. But Wendell kind of like predetermined that like if Shayna faced X, she would be able to make it through, and that's why you were willing to do that. So I kind of want to.
It's super key. I mean, think of that. It's like really in this world you will have trouble. I mean, it's literally biblical. And if you don't think that human behavior is predictable, or if you don't think that your founders are not going to go under stress and duress, you're crazy. And so my whole philosophy is let's just assume the worst and let's find people whose behaviors will respond in a way that they can survive. And that's part of the key is just, get through these first 5 or 6 years and figure it out, and you can have more success. And we've seen that to be true time and time again.
Yeah. Humans are remarkably predictable.
Yeah.
I say that all the time. Like the ability for me to predict people's behavior has gotten so good over the years because I pay attention to markets, and I've had to make decisions based on how I think people are going to react. And as a founder, you have to learn how to read people really well because you're always pitching to different people, and you got to know how to read your room really well if you want to be successful. And with public speaking, it's the same thing. But it's almost scary how predictable human behavior is. The outliers are the most obvious ones, but most people are very easy to like figure out what they're going to do next. And to your point, that can make it really easy for mathematics and stuff to predict it. Half the stuff that's in the market these days is predicated on human behavior affecting market movements. And then the people who win, and the reason why there's so few, is the ones that can see that as the opportunity. I did an interview yesterday with a Bloomberg reporter who was like, everybody's freaking out about the market. Do you think it's going to keep going down? And I was like, I don't really look at it that way. Like Buffett says, be greedy when others are fearful and fearful when others are greedy. But like most people can't actually do that. And the ones who can win. That's why Warren Buffett is Warren Buffett. Like if everybody was able to take on that piece of advice, then there would be no opportunity for Warren Buffett to stand out. But the fact of the matter is most people can't do that. And that's why he wins. And I think that's just so powerful for what you're saying. So I want to actually get into what I think is the most exciting thing of what you're doing. And we're seeing this come up more and more, but you guys were kind of at the forefront of this. And I always like and get excited helping the first ones. We have something that I just came across my desk related to this in the sports rights space that just got me all excited. But in your case, you were one of the very first venture capital firms, like very first, that was like, we want to do an interval fund product because interval funds weren't really a thing even 3 years ago. 2 years ago, when you made the choice to work with us, interval funds, there might have been 100 maybe in the
80.
market?
80.
80. Okay. 80. Like, again, there was like none. Today it's closer to 300, and every day a new one's coming out. But you were like, I want to do an interval fund. And I thought, well, that's great. And it took you a little longer than we had hoped, because, when it's a newer product and newer players are coming into it, like you, there's a learning curve. And so you had some learning that had to be done. But tell us a little bit about what made you want to launch the interval fund, because I think our audience and the advisors in it are probably really excited about what you're doing right now, and they should be even more excited because it's pretty available to their clients.
It is. So we spent a long time, with, lawyers and, other, asset managers, to really understanding, what was available, to us that would get me as close to the easy button for these advisors as possible. I think overall, we might have been the, fourth or fifth actual VC interval fund, to launch. I think, there's been one or two that have struggled because they were, if you think I'm cutting edge, there were a couple that were just a little too cutting edge and couldn't get distribution because of that. I didn't want to do that. Interval funds have been around, forever, but they've just never found a purpose, particularly with Americans' obsession, like with liquidity, right? And so for years, liquid alts and, liquid open-ended funds, was all, all the rage. But at the end of it, when you're doing derivatives or weird stuff, it was proven in '08 that they didn't have the diversifying characteristics. So for me, I needed to, at my core, we do primary financings. We are, as far as venture goes, we're as boring as you get. We buy stock in private companies all through North America, and that's kind of like all we do. We don't do anything weird. Okay, we're buying stock and product companies, mostly tech. So I didn't want to get away from that. And so the problem was I couldn't be an open-ended mutual fund because I couldn't liquidate every single day, because no matter what legal jargon that you put inside this stuff, you are buying, private securities that don't have an active market outside of secondaries, which is pretty small.
So, and don't tell Apollo this, by the way.
Yeah. So the interval fund, was a chassis that that I thought, could really get as close to that as possible, and then, also still be eligible for electronic trading, because the electronic trading, getting on, those networks that are the underbelly of, particularly the industry that I know and care about, the independent registered investment advisors, I wanted to skip forward through that subdoc process. And I didn't want closing on my fund to feel like a mortgage closing and all that stuff. Again, being available for, third-party asset management platforms, or whether you do that externally, whether you with an OCIO, or whether you build your models in-house, nobody had ever built a product that was going to fit nicely in that. Everyone up until this point, when they think about alts, private markets, or anything like that, they're always talking about, oh, I got a couple of high net worths. I'm like, well, what about the rest of your book of the business? And so I really had this, if you already have a relationship, you're already doing, the best advisors are already have some awareness or some access to alternatives, including private equity, maybe venture capital. But I wanted to answer a much larger question, which is there's 15 million non-accredited households that have IRAs in America. What about them?
The mass affluent, which I think there's like this. I think the industry, especially the larger players in private equity and venture capital, and I'll say the thing that Brad probably doesn't want to say, because I don't care. I think that the larger those folks don't view that marketplace, that market opportunity, all that seriously, beyond like selling them subpar products because they couldn't sell it to institutions. They got to put it somewhere. So let's see what we can do. And then they take the time to put it out to that market, but they don't really want to go through for, as they put it, small tickets. I don't want to deal with a small ticket, because then I got to have 100 small tickets when I could just get one institution or really wealthy person to write me one big ticket. Well, the one big ticket's a lot harder to get than like 100 smaller tickets. It's the same philosophy as when you're a financial advisor and you try to build your book. You don't care if that person has $1 million or $100,000. You just need clients.
That's right.
And to that point, I think largely speaking, until recently, when the institutional market's gotten pretty saturated now in the space, it's hard to compete in that market. You have to look at, well, where's all the other assets at? And when you pull together, to your point, the quote unquote mass affluent, which is basically everybody who has enough money to need a financial advisor, but not so much money that they can go in private bank and get like super special treatment, which is like the vast majority of, upper middle class folks. The cumulative asset base of that dwarfs the institutional space.
It's $100 trillion. And so for me, all those other things can be true and good for, all the named players, and look, good for them. But there's a great opportunity. There's many deals to be had in primary financings across North America that aren't on the coast. Our secret sauce was we were able to scale that manifests itself in lower fees, no carried interest. That manifests itself in an interval fund that could be sold. And so the end result is a product that is eligible for electronic trading on all the electronic trading networks, in the United States. And so I don't have to talk an advisor, out of whatever you're doing. If you enjoy that, keep doing. This doesn't need to be, a displacement or disruptive product. I just know from being an advisor that there's a bunch of your clients that you literally have no exposure. And if you look at the last month or year to date, in the stock market, look, it's choppy and it's scary. And we're just one weapon. There's other good weapons out there in a balanced portfolio, but we're one weapon that you can take to your clients and have a conversation instead of them pulling money and literally taking it to your banker to put in a CD because you're freaked out. If you want to take some public stocks, which are priced in a certain way, right, where they're correlated, and you want to have a conversation to say, well, maybe now's a good time to pull those private, then you need some product to do that. And so we built this with the advisors in mind. You literally can have that conversation with all your clients. It literally scales because you can put it in your models. You don't have to be like, oh my gosh, I got to do a review in person and get them to sign paper. No. If we're on your custody platform, just press a button, place the trade. It's kind of like magic.
I love it. And to your point, we preach this a lot at Bonran, and this is why we love Connetic, and we're so excited about the interval fund that you literally launched months ago. It's but the reason we're excited about it is something you just said there. It's like you made it for advisors. Like you always prioritized and focused on making it the best possible experience for an advisor because you were one and you understood that like the disrespect is real and the products aren't made for them and their clients mostly, and maybe it's intentional, but maybe it's just the vast majority of people creating product never were an advisor.
You said it earlier in your when we were talking about this. You said financial therapist, and it was funny you said that because my old partner Mike, he loved being the therapist, and that's ultimately why he was a better financial advisor than I probably was. I didn't enjoy the concept that's the fact of the business. It's actual financial therapy. But yeah, I have that. They absolutely. I'm in a financial advisor's office right now. I mean, when I see them walk out of these conference rooms here, with their clients, and their clients go out the door, I know what they go through. I know what they go through. And the bottom line is, we built a product. There's that checklist that the advisor goes through in their head or maybe in writing at the investment committee. And at its base level, I just wanted to build something that would get through the first gate, that they would go check, 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 check. Wow, this might be good for my business. I wanted to say, yeah, I know, because I was an advisor.
Right. That, literally what I talk to advisors, I say that. I built this to be centered around you, because I used to be an advisor and I wanted it to work for you. And I just want to kind of end on this note, to the advisors that are there. If they hadn't come through this conversation throughout, Brad and I both very much feel like the work you do is God's work. And we want to provide you with solutions that maybe can make the work you're doing a little bit easier for you and provide you a way to support your clients that they're not getting anywhere else. And that's really what it's all centered around, and what we truly believe. And I think that the industry is slowly starting to realize that how important that is. And I'm honored to have Connetic on the platform. More importantly, to share the vision that Connetic has. And in many ways, you are a trailblazer for what I culturally believe in strongly. And so I'm really excited to have you with us to make your product available. And we're doing some really interesting work with SmartX. And Brad is, part of that with the interval fund world, because just like anything, when you're a trailblazer in the space, interval funds have their own issues, and a lot of the platforms that exist don't know what to do with them. And so as we did with you, and as you did with us, you saw the trailblazing aspect of what we were doing, and that it might be a little painful in the beginning because it's unusual. SmartX is doing on their end as well. And so another partnership where advisors are being put first in these products, Brad's products, interval funds in general, are being considered, a way to really help advisors help their clients, because at the end of the day, that's the job.
That's right. Totally agree. So really appreciate you having me on. I've enjoyed this. I love talking advisor shop. I close with, I almost say this in almost every advisor meeting I have, being away from the business, for a decade. I'm glad that I built a product to sort of put me back in the business and partner with it. But I enjoy our partnership and I enjoy this conversation. Thanks for having me on.
Thanks for being with us. Like I said, I think this conversation, I hope the advisors that listen will give us a call, because I think Brad exemplifies what we look for, what we want, and what we're trying to build here at Bonrian. So thank you, everyone, for tuning into this episode. As always, if you like what you heard, hit that like button and subscribe. If you have ideas for potential guests or topics that you want us to take on, please let us know. We certainly want to be able to help support what you're interested in. And until next time, this is Shana Orzik-Sissel, founder and CEO of Bonrian Capital Management, and this is What's the Alternative? The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Bonrian Capital Management's platform. As such, Bonrian may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Bonrian Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Bonrian Capital trademarks mentioned are owned by Bonrian Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.